In today's video, I am going to be breaking down a great beginner portfolio that you could look at yourself. So first off, what is a good way to invest? Well, a great way to invest is, of course, there's a conservative way where you can get just like broad index ETFs that hold essentially most of the companies in, let's say, the TSX, which is the Toronto Stock Exchange, or you can get something like VOO or SPY that holds the broad S&P 500 stock market in the United States. Now, there's so many different options for those, but I'm going to get into a few of those anyways in this video. And at first, what is another great way to invest? It's in companies you already know, use, and hopefully love. So let's get down, let's check these out. So the first company is Apple. So of course, Apple is a fantastic company. They have phones, they have AirPods, they have everything. They have computers, they have the iPad that I'm writing on right now. They have the MacBook that I am recording to right now. Literally, a lot of people have Apple. And the reason why that's good is because, of course, that can give them the ability to pay a dividend, which means that, for example, here, for every stock that you own, you're going to get 88 cents per year, of course, divided by 4 because they pay it quarterly. Now, you may be saying, well, $146 a share is a lot of money. Or you could be saying, well, I can't get any reasonable number of shares at $146. Well, guess what? There are a few different trading platforms out there that can give you divisional shares. So 1 out of 12 maybe. But generally speaking, Apple has gone through a few splits over the years, so you could get into even just 1 share today, and you'll be fine in the future because they might split it 10 different ways, let's say 5 years from now. Which means that you would have 10 shares of Apple, but it would be at 10% of the price. So that's how share splits work. It doesn't really benefit you any at all, but it does give you more shares at a lower price so that you can get in maybe on more shares potentially in the future, things like that. But remember, anytime that you're buying stock, what you want to do is, of course, buy enough to cover that commission. So if you're trading with a bank, for example, TD, which is what I use most of the 99% of the time, is a $10 commission, $9.99. So if you were to buy, let's say, Apple at $146, it would actually cost you $156. However, if you were to buy, let's say, 1,000 Apple shares, that would cost you around $1,460 and about 40 cents per share if you were to buy 10 shares, let's say. And really, because there's that, I'm going to call it $10 to make math easy, $10 commission, you're actually only raising the cost of that share by $1, which would make it $1.47 a share, which would then make this total amount $1,470, which is why it's usually better to buy more shares at once if you're on a platform that has commission. Another thing that you want to look at is the volume. Is the company that you're investing in have a lot of volume? And at 80 million shares average per day, you're going to be able to get in and out of this very easily. Something else that's crazy is the PE, or the earnings per share, as well as, of course, PE ratio. Some people really go by earnings per share. I personally like to go by PE ratio, which is price versus, or price to earnings, which right now is at 28.58. You wouldn't compare this to the whole market. You would compare that to the other stocks in its same field. So, for example, here the competitor is Microsoft. I also like to look at the chart. That's just a personal thing for me. And we can see 5 years ago this was trading at $25 per share. Today it's trading at $146. We can see that it's had some ups and downs and ups and downs and more ups, but ultimately a lot higher than it was 5 years ago. You generally want to time this when, of course, volume goes up and when share price goes down. So for example, here we were having some pretty big volume days versus what was happening earlier. And of course, when COVID hit, we had ridiculous volume. Anytime you really see this, again, down here corresponds with up in volume. Anytime you see a big downturn with lots of volume, start buying in very slowly, a little bit at a time, and then that way you can hopefully time the bottom. Now, of course, nobody wants to buy on a down day, but you remember what Warren Buffett said: be greedy when others are fearful. And then, of course, on the flip side, you want to be fearful when others are greedy. Right now, in Canada, there's a housing market boom going up 25% per year. Every year, it seems like. Well, guess what? That's a bubble. Eventually, when you start getting real estate agents saying, hey, the prices are never going to go down, ever, that's usually a good sign that there's going to be a correction sometime soon. They also raise their dividend quite often as well. The dividend is what the company pays you for holding their shares. It's taken out of their earnings. Something else I really like to look at is their past earnings. Of course, do they beat what analysts think that they're going to do, which of course Apple has been doing? Are they also making more revenue every year? Remember, revenue is king. No matter what business you're in, revenue is king. You can have negative earnings for a very long time, as long as you have lots of revenue. Look at Amazon as an example. For a very long time, they had killer revenue, no earnings, because they were growing. And because people were investing, they still had the money to be able to take on not having earnings. Well, Apple has earnings lower versus 2018. However, I do see that going up because, of course, revenue is steadily, on average, going up. TD is another good investment, especially if you're in Canada. However, it's not just TD that I'm mentioning. I'm only mentioning TD because I personally bank with TD. Whatever bank you are with, if they are a Big Six bank, definitely buy shares in that bank. The reason for that is they pay a very high dividend. Of course, if you're at one of these so-called free banks, which they're not technically free, but you can read into that in a totally different video. I can't remember if I've made one yet about that, but free banking is not really free. And from there, there's a big bank that actually holds most of those free ones. So, yeah, it's kind of interesting, to be honest with you. The banks own another bank to give you a deal, but they're still making a killer deal on that stuff. So you have to remember that. So TD is the bank that I like, and of course the one that I bank with. So that's why I at first invested in TD. I have then also just diversified across all the banks as well, except for Royal Bank of Canada, which is interesting. But the reason is the dividend, 3.7% dividend. And when you really start looking at that, guess what? If you're paying a bank fee right now, this could essentially pay your banking fees. Now, of course, the bank account I have is just ridiculous bank fees, way up in the sky. I need to have at least $5,000 to have no banking fees in the account. And for those people who can't have, or if you right now have enough money in your checking account so that you don't have to pay ridiculous $30 or $40 a month administration fees, well, guess what? If you've got enough in there and then you can buy TD stock, this dividend will eventually pay you back all the fees that you've paid since you were a kid. Volume is 4.8 million shares traded per day, so you're going to be easily able to get in and out of it. Check out the PE ratio versus other Canadian banks. Right now, this is on the lower end. Generally, Canadian banks, I try to only buy when they're below 11. If they're below 10, it's a steal. And most of the banks did trade sideways for about 2 years or so before, of course, the big virus and, of course, the explosion after the virus. Now, to keep in mind, not all banks traded sideways like this. National Bank was one of the banks that was actually growing during that time. So that's why you want to be diversified across the banks. Now, another thing is they tend to grow their dividends at a pretty good clip every single year. Of course, right now they're not allowed to raise their dividend because of COVID. However, once that ban is lifted, guess what? They haven't raised a dividend for over a year and a half, almost 2 years. Look at the increases that they've had in the past. They've gone from 67 cents to 74 cents. Which is a 7-cent raise, and then they went from 74 to 79, which was about a 5-cent raise. So now, if you can think, at least my reasoning or rationale behind why I think that they're going to be really raising it huge is if you add 7 to 5, you kind of look at about a 12-cent raise in dividend, which would then bring it up to about 91 cents per share. That is a massive raise year over year, and they are also making more money, and I would not be surprised if that dividend went even higher than that. Now, TD is not one of the banks that made exorbitant amounts of money during COVID. They did do really well when it came to earnings. However, a lot of banks did do extremely well during COVID because especially the American banks, they actually charged a fee for receiving those COVID checks, which then they're making money because everyone's getting COVID checks. And then on top of it all, people started investing more, which means more commission fees coming to them. Things like that. And it's actually quite interesting how much money they actually made because of COVID. But I really want to break down this mastery. Check this out. Lower revenue year over year, actually lower than it was for 2 years. But check out those earnings. Higher than they were in the previous 3 years. So they are making more money on lesser revenue. When those revenues go back up, their earnings should also go even higher. So that is why I personally feel that they have been able to figure out how to cut costs and, of course, make more money. They are also absolutely blowing out analyst estimates for the last 3 quarters, and then they also beat the analyst estimates 4 quarters ago. Next is Google. And of course, Google, guess what? You're on YouTube right now. Google owns YouTube. Do you have a Nest thermostat in your house? Google owns Nest. Google is Alphabet on the stock market, and Google owns a lot. They also sell a lot. They make a ton of money. So, obviously, this one doesn't pay a dividend. They're still looking to grow. They are investing into AI, artificial intelligence. Someday computers are going to be smarter than us. So, that seems like a pretty solid company. Everyone uses it. When literally the whole world uses something, you should probably invest in it. When you have the whole world that says, I don't know an answer, better Google it, guess what? Yeah, you have a market, you have cornered the market, and who uses Yahoo anymore? Nobody. Who uses Bing anymore? Nobody. Google is literally the only company that 99% of the population uses. So, it seems like a pretty solid company to invest in. It seems like they kind of have maybe a monopoly. But yeah, like you're looking at 1 million shares on, of course, Google. There's, of course, the other version of this same stock as well. And PE ratio, I would kind of compare it to Apple in a way. It's very similar anyways. Remember, Alphabet is Google that sells Android as well as cell phones, so keep that in mind too. And they've had a massive run from $750 to $2,750. So literally, if you bought one share 5 years ago, you would have made around $2,000, which is ridiculous. I also like looking at the MACD, and it's kind of getting a bit high right now. There could be some downwards pressure on this, but it's hard to say when you're looking at a company like Google. Of course, blowing out 4 quarters, just absolutely killing it when it comes to revenue and earnings. Like, check out that. Like, this is, if you are running a business, this is what you want to see. This is literally high as anything revenue, like $180 billion worth of revenue. That is an unfathomable amount of money. I don't know why more people don't invest in this. $40 billion in earnings. Like, oh my God. I wonder how much tax they pay on that. And of course, if you're in Canada, you can invest in something like XIC. XIC is actually a pretty good ETF. It basically holds most of the TSX. Of course, it's capped at a certain percentage. Some of the key facts are that it holds 229 stocks, which means that if one or two stocks tends to plummet, you don't really have to worry. The 12-month trailing yield on this is 2.5%, so it's not going to be paying as high as something like TD, but it does hold TD stocks, so still a great option because you're not necessarily looking to have massive dividends with this one. You just want to have something that will hold your money, get hopefully better than, of course, inflation, while making a dividend. For those who are looking to have a nice, safe retirement, this is a great way to invest. Or if you are looking to possibly use the money soon, this is a great way to invest. Or, of course, if you want to not risk money or have a high risk, or if you have a low risk tolerance, let's say, getting a 2.5% dividend is still pretty good. Now, remember with ETFs, there is a fee. However, with XIC, 0.06% management fee is really not that much. This is basically the fee that they take from you for investing your money. So for example, if your account was at like $1,000 as an example, this would end up being like $6. It also holds the biggest companies in literally Canada. Like Shopify is currently the biggest company at this point in time. Then you're going to Royal Bank, TD, again, banks. You're going to see with Canada, it's going to be mostly oil and banks. That is just how Canada is. Brookfield Asset Management, which is essentially a bank. It's a financial institution. Enbridge is oil. Bank of Nova Scotia is a bank. And then CNR, which is technically an oil play because we just have no ability of ever getting pipelines made in Canada. And then Bank of Montreal, CIBC, and then Canadian Pacific for essentially the same reasons as Canadian National Railway. I used to invest in Canadian National Railway. Now I just do it through ETFs. As we can see, very financial, very energy, huge parts of Canada is that. Industrials is another one. Information technology is growing and will continue to grow, so we have to remember that there's going to be more and more tech companies in Canada that will become larger. So overall, that is the actual sector breakdown, and it seems pretty solid. That's the growth over the past 1 year in this case, 10,000 up to just over 12. And of course, if you look at 5 years, which is what I like to look at, 5 years you go from 10,000 up to 16,000, which is about a 60% return. So again, remember, we'll just ignore that because it's COVID, but other than that, it's still a great way to invest. You can see that it's a pretty safe return. Another option is VOO if you're American. This one's going to be much lower percentage dividend, mainly because the Americans don't tend to pay as high of dividends as Canadians do. Again, great volume. Expense ratio on this one is 0.03, so it's going to be even cheaper. It's about $3 for every $1,000 that you have in the account. And of course, when you start looking at the 5 year, you're going from about $200 up to $400. You're doubling over 5 years, so it's a pretty solid bet as well. You generally want to see higher dividends. Of course, lately, lesser companies paying dividends, so that's because of COVID, but it'll return. And top 10 holdings: Apple, Microsoft, Amazon, Facebook, Google, Berkshire Hathaway, Tesla, my favorite, and Nvidia and JP Morgan, another one of my favorites, and Apple, of course, is the top. So overall, solid company. So that's one way that you can invest. If you have enjoyed today's video, hit that like button, subscribe. I'll see you guys again next time.